Now for our Sunday agenda budget preview, I've got two of the best in the business, Chris Richardson from Deloitte Access Economics, Warren Hogan, Economic Advisor at Judo Bank. Thank you both so much. Chris, first to you, your overarching thinking. If we're going to repair the budget, it's got to be economy-based. We've got to repair the economy.
Yeah, look, that's rule number one. And it's important for people to understand that the fastest way to repair the budget is to repair the economy. Most of the emergency spending was temporary. The budget was in balance, basically, when COVID hit. If we can get the economy right, that does almost all that you need in terms of nursing it back to health. And that's exactly what's happening. You know, on budget night, the Treasurer will announce deficits that are substantially lower than the last time the government updated those official forecasts. And it will be because the economy is substantially better. But we can't stop yet. The government, earlier in the crisis, when it looked rather more scary, set a line in the sand, said basically it would keep going until unemployment was comfortably below 6%. We're already there, but we need to go further. The Reserve Bank aims for an unemployment rate of 4.5%. The government should shift its line in the sand. Note that it's a sign of success and that they are aiming for an unemployment rate comfortably under 5%.
And Warren, your view is this budget is one of the most important for decades.
Yeah, that's right, Kieran. I think the next three budgets can really set Australia up for 10 to 15 years ahead, for a whole generation. I think potentially the most important set of budgets since the 1980s. But this one right now, to Chris's point, is actually about consolidating the strong performance through COVID. It's about keeping that momentum in the economic recovery. It's not about the big reforms. It may be laying some foundations for these two budgets after the next election, which I think are going to be big budgets for reform. But this one's actually, the real priority is about converting the COVID recovery into a sustained economic upswing.
And Chris, you want government and voters to think about debt in a different way, I guess, to what we have in recent years. Yeah,
and look, all of the headlines about the budget in recent times have been, huge debts, huge increases in debts. And that was the cost of fighting off COVID. But it's not the right way to think about that cost. Everybody's, looking at Treasury's forecasts for debt before COVID and where they were at that last update. And it's true that before COVID, the forecast was considerably down on debt to national income. Now, of course, debt to national income looks a lot higher. That seems scary, but it's also the wrong way to think about this, right? That's not the true cost of the defence of our lives and livelihoods using the budget. Yes, debt has gone higher, but interest rates have gone way, way lower, and that gives you double the benefit. You get those low interest rates not just on the new debt, but also on your old debt, the stuff you had before COVID. As that comes due and gets renegotiated, you're getting the lower rates there. If you're looking at the cost to the budget the right way, you would be looking at interest costs. And as a share of national income, they were headed down pretty fast ahead of COVID. They're still headed down now. And the average person in the street does not understand that. The cost of what Australia has done really hasn't been that much, and overall interest costs headed down.
And further to that point, Warren, this is one of your arguments as well, that there needs to be patience when it comes to the notion of budget repair.
Yeah, very much so. As Chris alluded to, the budget's going to be in a much, much better position than we thought even just before Christmas, because of the much lower unemployment rate, stronger domestic economy, and of course very high commodity prices, particularly iron ore. We're going to be in a much better starting position. And because the economy is doing so much better, and it really is, the economy, there's hints of boom in certain parts of the economy, there will be a real temptation to do further fiscal consolidation, to really sort of politically make the point that this government likes to do is to get the budget back into into order quickly. That's not the right strategy right now. Allow the economy to do the repair for the time being. I do believe at some stage we are going to have to do a further discrete fiscal tightening to get the budget back into a sustainable position by the middle of the decade, but that can wait. That doesn't happen now. So I think the government needs to be patient. It needs to stick to its plan and allow the strong economy to be the major driver of budget repair for at least the next 12 months, if not a bit longer.
One of the supports that's been removed is the end of JobKeeper, Chris Richardson. I think it's got a lot of people in business and the broader economy a bit concerned about that impact.
And lots of people are, and this actually gets back to the heart of what Warren was just saying. People, I think, misunderstand what's been happening with JobKeeper and the other supports, the emergency supports to people on the way through this. If you actually look at the timing of that support, the peak of it was in the middle of 2020. You know, the end to JobKeeper a handful of weeks ago. Sure, it's important, and particularly important for some people, but it is nothing like the size that I think many people still think in their minds about this. Australian national income is about $170 billion a month. And at its peak, we were pouring, in the middle of 2020, $30 billion in a month back into the economy. But that, you know, that phase was long since over. The withdrawal of the emergency support was much bigger between July and August on the one hand, and by the time we reached October, the recent withdrawal of support, and again, you know, important for the million workers who were working for businesses still supported there by that when that happened. But it is a much, much smaller hurdle for the overall economy. What's happening around vaccinations means there's still a need for sticky tape. We got livelihoods through this crisis by the government throwing money at it, taxpayers supporting. Current support is as simple as keeping COVID numbers really low. We've been doing that with borders. The intent was, and still is, to do that with vaccinations. It's just going to take a bit longer on that front.
And you want, Warren, the foundations to be set for an investment-led recovery. Talk us through that.
Yeah, so we have obviously a very strong level of domestic demand growth in the economy because of the government's stimulus and the RBA's very, very easy monetary policy. We've got to convert that demand into a sustained, continued economic expansion. The only way to do that is to get investment spend up. And, you know, for example, strong demand for housing, lots of borrowing, mortgages and house prices going up, that's fine, but you need to turn that into house construction. And we will see that, but that needs to be sustained over the years ahead. We need to get commercial construction, infrastructure spending, all of that picking up. But the most important element that I believe we need to see occur in this economy over the next 3 years is to get non-mining business investment picking up. I've got a chart here that shows the dollar value of non-mining investment in plant and equipment, what I call core CapEx. It's a good indication of the momentum in business spending. It's been flat for a decade. Now, some of that's because of the mining boom, but really we've got to get that lifting off. And I think we'll see some pretty good outcomes this year with the instant asset write-off being unlimited, being very generous, but that finishes in June 22. And I worry about what happens after that, because that could actually fall back with the instant asset write-off, bringing forward some business investment. The key is small, medium enterprises, SMEs. The RBA's done some research recently that shows that they're half the output of the economy, but 60% of the investment. And they do face many challenges, from scale issues around regulation and labour costs and these sorts of things, all the way through to access to funding. The government needs to support that sector, and I think they should seriously consider some sort of an investment allowance post the end of the instant asset write-off to help secure this recovery into a long-term economic expansion. I think that's something they need to address in this budget.
Warren Hogan from Judo Bank, Chris Richardson from Deloitte Access Economics. Gentlemen, thank you both. Look forward to talking to you closer to the budget.
Thanks, Kieran.
Thank you.